Welcome to episode 8, Selling Options on Moderna. I'm going to show you how option sellers did on Moderna from just before the pandemic to July 2022. We'll look at puts, calls, and a little different from previous videos. I'm only going to change one variable. I'm going to do calls with changing deltas, calls with changing days to expiration, puts with changing deltas, and puts with changing DTEs. I'll set the minimum volume to something that works for viewing the data on the charts. So I don't want too few or too many legs. We'll look at some individual and some aggregate back tests. We'll consider what strategies could have been used this period. And feel free to give your opinion of what strategies should have been used. This is not trading advice. Do not do this because I say it worked on Moderna. For God's sake. Just because it worked here doesn't mean it'll work in the future. The Yahoo chart in the background is Moderna from January 2020 through July 2022. It's the same as the back test that will be shown shortly. Here's the big pandemic money printing mountain. The way up was probably not so kind to call sellers, and the way down was probably not so kind to put sellers. We'll see how it all shook out though. Full disclosure, I'm invested in Moderna. I've sold puts, I've sold calls, and strangles on it. So I'm a little biased in favor of Moderna. But the data has no favorites. It'll say what it'll say. If it's your first time here, this channel is about running back tests on options, usually selling options, then talking about the results to see if they might apply to future situations. If this sounds interesting, please hit the like and subscribe. Feel free to request a back test or features, and let's get started. So I'm going to show you 4 quick slideshows. The first one is calls with a changing delta. Here's the first slide here. Things to note are the number of legs. This is going to be the lowest delta. It's going to go up by 2 each time. You can see the days to expiration can vary all the way from 2 to 60. And then notice this one lost about over $500 or $50,000. So let's just page through these guys. See, this is also a loser. The delta went up to 10. The delta goes up to 12. It's also a loser. 920 legs. 869 legs, and one thing to note is they're all loser. Well, that one was kind of close. But yeah, it only lost just over 200, but it only had 712 legs. Loser. See, we're all the way up to 0.4 delta, 4.2, 4.4, 4.6, and then there's the highest. So every single one was a loser. And to quickly recap what was said in previous videos, the length of these blue lines represents the option contract lifetime. So since the days to expiration can vary, notice the lengths are different. In the past they've always been the same, but since we've got lengths going from 2 to 60, these lines are all kinds of different lengths. So here is the second slideshow. Puts with the delta varying from 0.08 all the way up to 0.5 negative for puts. Same thing, the length of the contracts can vary. And you'll notice that, so the puts are just the opposite of the calls. They actually did well while the underlying stock was doing well, and then did badly when the underlying stock went down, which the calls did just the opposite. So let's see if we can see any winners in here. Nope. Oh, this one lost $200,000 and 775 legs. Ouch. Nope. We're all the way up to negative 30 delta. Let's keep going. 600 legs, 500 legs, 500 legs, 500 legs. So, all losers. Slideshow 3. This is calls, letting the delta be whatever, and then slowly increasing the days to expiration. So this first one, see the really short lines, these are just 2 to 4 days long. So this one was a loser. This one was a loser. We're up to 8 to 10 days, loser, 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 loser. So this one almost worked its way back up. This was 3 weeks, basically. And this one was a loser. Here's a winner. Look at this. 26 to 28 days. It only had 257 legs, but it eked out a little profit somehow. Loser, 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 loser. We're up to 40. We're up to a month and a half. Loser, loser, loser. Only 279 legs, 198 legs. Oh, this is the longest one. 2 months. Okay, last slideshow. Puts. Slowly increasing the DTE and letting the delta be whatever. This one had 3,000 legs, little short ones, 2 to 4 days, and wow, that is a pretty steep fall there. It lost over 250,000. Not good. And loser. Oh, that one almost. Wow, look at that. The 5 to 7 days only lost about 660,000. Much better than the shorter one, but still, zoom right down the toilet. Loser, 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 loser. Oh, that one's not bad. 1,000 legs too. We're up to 2 weeks. Loser. That one was not good. Loser, 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 loser. Only 200 legs in this one. It was a loser. We're up to 4 weeks. Almost. Loser. 500 leg loser. 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 Here's a month and a half, still losing. Not much. This one was actually really close to winning. Losing, 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 and there's the biggest one, and it was a loser. So that's it for the slideshows. So now we'll take a look at the 4 aggregation charts corresponding to the 4 slideshows we just watched. This is calls with increasing delta. So these blue lines are the profit loss. So as you can see, they were all in the negative in this aggregation chart. And here's the number of legs, just so we can make sure that there's enough data in each backtest to make it believable. So down here on the bottom is the increasing delta. So as we can see, these smaller deltas seem to lose a little less money, even though they had a few more legs. And then the losses seem to kind of like increase and then become steady as the delta went along. Yeah, not much else to say about this one other than all losers, and smaller delta may have done a bit better. So here is the aggregation chart for calls with increasing days to expiration down here on the bottom. So it has a little different characteristics than the increasing delta. You can see the number of legs is more when the days to expiration is smaller. I guess that's not real surprising. And once again, the profit loss, the losses were smaller when the days to expiration were smaller. And the longer expirations really got killed, even though they didn't really have that many legs. This is the one winner, but it had so few legs that it just doesn't seem very interesting to me. Not even worth the trouble to look into it. I mean, I doubt if there's something significant about the 27 or 28 days to expiration option that would make it a winner. It's just an anomaly. So here is the third aggregation chart. Puts with increasing delta. It tells a similar story. I would say the losing was a little more consistent here, although there does seem to be a trend toward bigger losses per leg as the delta goes higher. The volume is a little higher with the smaller delta. So really nothing much to say here other than call sellers lost and call buyers won. The number of legs being more for the smaller delta is a little surprising to me, because all of the stuff I've read or watched about selling puts is you want to try and get your delta a little bit higher because you don't mind getting assigned with puts, because that's how you want to buy your stocks. But I guess these may be more of a protective put, where people are just buying insurance to make sure they don't lose too much money. But that is kind of interesting to me. So here's the last aggregation chart. Puts with increasing days to expiration. As you can see, the volume or the number of legs are way higher with shorter days to expiration. And the average profit loss per leg is smaller and increases as the legs get longer, which makes sense. I mean, for a longer leg, if it's in a losing situation, it's gonna lose more. But these long legs, they don't have a high number of legs, so really not enough data over here to be significant. But once again, they're all losers, but a couple of them were really close to break even. But there's little doubt that option sellers had the worst of it in all of these 4 different brackets. So what does all of this mean? Option buyers had the best of it with Moderna over this time period. Out of 84 back tests, only 1 showed a small profit, with many having huge losses. Being a member of team option seller, I have to give it up. Option buyers win here. This means the market's implied volatility has been too low for Moderna over this time period. Or in other words, the market has not anticipated the big moves up and down Moderna's made. I'll speculate that this means Moderna implied volatility could be too high going forward for the next X time units, and possibly more kind to sellers. But I could be totally wrong. Anyway, don't lose hope, option sellers. This is just one highly volatile stock over this time window. And I believe in general, market IV is usually a little too high, giving sellers a slight edge. But there are definitely pockets of the market like Moderna where buyers have had the edge. When I started selling options a few years ago, I was naive enough to think sellers almost always had the edge. I think Moderna shows this isn't the case. I'm hoping to narrow in on who has the edge and when, and that's kind of the purpose of this channel. I'm not a financial advisor. This isn't financial advice. It's just a peek at the data and draw your own conclusions. Up next, probably something similar for Tesla, AMC, or Meta. Also, I'm going to implement backtesting for spreads and buying options soon. Thanks for watching until the end. Like and subscribe, and let me know if you have any ideas or would like to see any backtest or features.